While you are watching silver collapse from $90 and second-guessing every financial decision you've made, someone else was aggressively buying. Not cautiously, not in small size. This looked like deep, strategic, large-scale accumulation, the kind normally associated with nation-level positioning. And the footprint left behind in the data tells a story that could either make you very wealthy or very frustrated, depending on where you're standing in this trade right now. Because what the charts revealed this week doesn't just hint that silver may rise, it strongly argues for it. The structure points to a move that is not random, not emotional, but mathematical. By the end of this breakdown, you'll understand why a $300 silver scenario by summer is not just hype. It mirrors a pattern that has already happened twice in modern market history. And in both cases, the people who recognized it early changed their financial trajectory. If you value deep analysis like this, make sure you subscribe. This channel focuses on the angles mainstream financial media rarely explores. And in the comments, write "silver to the moon," so I know you're watching closely and thinking critically. Let's begin with a simple but powerful fact. Silver recently broke above $50 for the first time in 50 years. Half a century. From 1980 through 2025, silver lived inside a cage between roughly $4 and $50. Every approach toward $50 was rejected, hard. It happened in 1980. It happened again in 2011. Each time price was pushed back down, and the ceiling held. Over time, the financial world accepted that boundary as permanent. Silver became known as the $50 metal. Analysts repeated it. Media reinforced it. Generations of investors absorbed it as truth. But here's what rarely gets mentioned. Other major commodities did not stay trapped like that. Gold broke above its 1980 high, then above its 2011 high. It continued setting new records across decades. Copper spent years range-bound, then exploded higher after its breakout. Other metals followed similar paths. Long compression eventually led to violent repricing. Silver alone remained capped. Until now. 50 years of price compression stores enormous energy. When pressure like that finally releases, moves are not small. They are explosive. Historically, multi-decade breakouts don't produce 10% gains. They produce multiples. That's not emotion. That's pattern behavior. I went back and studied the last two major silver surges in detail. What I found was remarkably consistent. From 1979 to 1980, silver rose from about $12 to $50, a four-fold increase in just 5 months. Not years, months. Then from 2010 to 2011, silver ran from around $18 to nearly $50, more than doubling in roughly 7 months. In both cases, the biggest gains came fast, and both runs included a sharp mid-move correction that scared out weak hands, a violent pullback that convinced people the rally was over. Each time, that correction turned out to be the final opportunity before the strongest leg higher. Now compare that structure to what just happened. Silver began accelerating in November. That was month 1. December was month 2. By late January, price spiked above $90, then came a brutal, fast crash that shook confidence across the market. That sequence, surge, shock correction, sentiment collapse, closely resembles the earlier historical patterns. If the structure continues to follow precedent, the most powerful phase of the move would normally occur in months 3 through 6, which places the critical window into early summer. But there's a major difference this time. In both 1980 and 2011, silver's surge stayed inside the old $50 ceiling. This time, the ceiling already broke. The half-century barrier failed. And even after the crash, silver held above that former cap. Old resistance is now acting as new support. That is classic breakout behavior. Think of it like a dam that held back water for 50 years. Pressure built continuously. Every test failed, until a crack formed. When that kind of structure gives way, the release is not gentle. It's forceful and sustained. That's the technical picture silver is painting now. Another major issue many analysts are getting wrong is tool selection. After the crash, numerous market commentators said they sold everything at $90 because indicators like RSI showed overbought conditions. Technically, They weren't wrong about the pullback risk, but they applied legacy indicators built for a range-bound market to a regime change breakout. That's like using a household thermometer to measure lava. The instrument isn't calibrated for the environment. Momentum readings that once signaled exhaustion during the old $4 to $50 range may not apply after a structural breakout. Long-term momentum has already exceeded levels that marked prior cycle tops. When regimes change, indicator interpretation must change too, or investors exit too early and never re-enter. Psychology then becomes the trap. Once someone sells, buying back higher feels unbearable. Many never do. They end up correct about the dip and completely wrong about the trend. Right now, viewers fall into three groups: those who sold and want reassurance, those who held and want confirmation, and those who waited and fear they missed the entry. But markets don't respond to emotions. They respond to structure and liquidity. And the current structure resembles the early stage of prior explosive runs. There's also something else largely ignored in mainstream coverage: the pricing gap between Shanghai and New York silver markets. Recent comparisons have shown roughly a $30 per ounce premium in Shanghai. That is not noise. That suggests tightness in physical supply relative to paper pricing. When physical markets consistently price higher than futures markets, history shows futures tend to rise to close the gap, not the other way around. China has also implemented export controls limiting who can ship refined silver abroad. A large share of global refining capacity sits inside those borders. Restricting outward flow tightens international supply availability and contributes to regional price premiums. Bullion dealers in North America have also reported difficulty sourcing physical metal at quoted spot levels, with widening spreads between screen prices and real delivery costs. When physical premiums expand, it signals stress in supply chains. Silver demand itself is driven by two major forces. First is industrial use: solar panels, electronics, AI infrastructure, medical technology. Much of that silver is unrecoverable once used. That permanently removes supply. For several consecutive years, global demand has exceeded new supply. The second force is monetary demand. Silver has functioned as money for thousands of years. Regulatory developments in India allowing silver to serve as recognized collateral expand its monetary role again for a population of over 1 billion people. When an asset shifts from purely industrial to monetary, demand dynamics change dramatically. Gold has already been riding the monetary wave. Silver historically follows gold, often later but more violently. The gold-to-silver ratio remains historically stretched. When that ratio compresses, silver typically outperforms. Macro conditions add further context. Long-term dollar momentum has weakened. Money supply expansion over decades reduces purchasing power. Precious metals historically reprice to reflect that currency dilution. Bond markets are also under strain globally. When confidence in government debt instruments weakens, capital historically rotates toward hard assets, especially gold and silver. The broader commodity complex is also breaking higher: energy, agriculture, raw materials. Commodity uptrends tend to coincide with precious metals' strength, particularly when inflation expectations rise. Meanwhile, equities have shown sideways behavior relative to metals' performance in recent months. That suggests early stages of asset rotation, from financial assets toward tangible assets. When multiple macro signals align, currency weakness, bond stress, commodity breakouts, physical premiums, supply deficits, and monetary adoption, probabilities shift. Historical gold bull markets have produced roughly 8-fold advances from cycle lows. Applying similar multiples to recent gold lows produces targets in the $8,000 plus range, numbers now echoed by major institutional forecasts. If gold reaches those levels, and the ratio partially normalizes, triple-digit silver becomes mathematically consistent, not sensational. None of this removes risk. Silver is volatile, corrections can be severe, leverage magnifies danger, mining equities can drop sharply even in bull cycles. Policy changes, deflation shocks, or supply reversals would weaken the thesis. This is pattern analysis, not financial advice. Near term, the pattern suggests a stabilization phase, choppy, frustrating, range-bound, before potential continuation. Historically, the second challenge of prior highs after a shakeout is where acceleration begins, because overhead sellers are already gone. If the historical timing analog holds, the critical window sits between March and June, months that previously delivered the strongest gains after breakouts. Years from now, investors will look back at the $90 crash moment as either the panic exit or the recognition point. 50 years of compression has already broken. The old ceiling failed, and price remains above that former boundary. The floor of the new range is the ceiling of the old one. That alone makes this period historically unusual and worth very close attention. If you found this analysis valuable, don't just watch, take action. Hit that subscribe button so you never miss these deep market insights. Drop a comment below telling me where you're watching from and what time you're seeing this. I want to know who's paying attention. And if you believe in silver's potential, type "silver to the moon" in the comments so we can see how strong this community is. Finally, share this video with anyone who needs to understand what's happening with silver. Knowledge like this moves fast, and you don't want to be left behind.